Good afternoon, ladies and gentlemen. It is August 5th of 2024, first week of August. Not a pretty one in the stock market. We've talked about the last couple of weeks, how we expect it to be in a temporary moment of weakness as stocks started to pull back. And most importantly, the weakness has really been centered in technology, those mega cap tech names such as Amazon or Tesla or Google or Meta, otherwise known as Facebook, those magnificent seven names, including NVIDIA. That's really where the center of the weakness has been. I mean, a lot of those names are off 20, 30% from their June peaks. And that's important because those are big companies with multi-trillion dollar market caps. We have proactively tried to avoid that space. That doesn't mean that obviously we're not down. We have come down with the rest of the market. Every last week was one of those weeks where everything goes down, and we could try and time weeks like that and put hedges on and try to go to cash. But what we have found historically has been that we can try and do that, and we start off in good shape by avoiding some of that downfall. But then you kind of miss those big up days, because when the market finally does bottom, you're going to get two or three successive aggressive up days. And if you miss those days, that's a big deal. So while last week was not fun, you saw everything go down, including yields, but that's going to be an important theme. We actually really, really do like how things are positioned, because when we get out of this, we're in a new world. Before this market correction started, yields were high. After this market correction ends, we believe yields are going to be very low. That's the first thing. The second thing, inflation was high coming into this correction. We're now in a disinflationary environment where we're going to see lower inflation in our belief. So that's number two. Number three is a potential soft landing in the economy, an overheated economy going into this correction, and a cool down economy coming out of this, right? So, and I think from an investment perspective, you really had this environment where everyone was chasing seven stocks and everything else was sort of left in the dust. Now, as rates are coming down, it's opening up the universe to a whole bunch of different types of stocks and themes and investment styles. And that's where we think the current asset allocation as we position portfolios is really going to prosper, and sort of that lower rate environment where more and more companies have access to capital and can compete against some of the bigger guys out there. So that's what we're going to go through this week. As usual, I'm going to go ahead and share my screen. And the title of this week's presentation is What to Do Now. Everything is getting hit. And when you go into those weeks where everything is getting hit, you had the Russell down 4% on Friday. You had the NASDAQ down around 3% on Friday. You had names like Amazon that were down double digits. You had Intel down 30%. These are not small companies that are down massive amounts. What do you do now? And I think the key is not trying to put a game plan together that tries to time the next 5 days. Is to say, okay, when this correction is over, and it will be over at some point, what does the world look like? And remember, we talked about those 3 points: a cool down economy that's no longer overheated, an interest rate environment that's defined as low, not high, and an inflationary environment that's defined as lower, not higher, right? And understanding, okay, what type of investment portfolio, when you're looking at that new world, can potentially benefit and make us a lot of money. So we're going to go through those concepts this week. The 3 big things: what causes selling to accelerate this week? Is it time to buy big tech? I kind of jumped the gun here and say, no, we don't believe so, but we'll go through why. And then what are the areas, as we talked about before, that stand to benefit or lose from a lower interest rate environment? So the tech weakness is ongoing. I think the big thing from a technical perspective, when we're looking at the quant metrics out there, is that really at the end of the day, the percentage of stocks, technology stocks in particular, that are above the 50-day moving average is still around 45%. So it's very difficult for us to say that the sector has been flushed out. Now, I will be mindful here that this is a Thursday number. It does not include Friday's number. So, call that 30%. That's still really not in that extreme ballpark of where we'd want to say, okay, like at least as a trade, let's buy some tech here, right? So we're not there yet. We talked a little bit last week how we didn't think we were there yet, and we're still not there yet. And this is the center of the storm. And we think coming out of this is not technology leadership that defines the market, but it's low interest rate impacted stocks, right? Stocks with high leverage, stocks that are small cap in nature or value, or stocks that do well as stores of value, right? So it could be like digital assets, right? So those types of areas are areas that we're focused on. So the economy is slowing. I think that's a theme that we've talked about for the last 2 months, perhaps, where we talked about those brown shoots. So instead of green shoots, those brown shoots where we are starting to see evidence that the economy was slowing. Well, last week we sort of got not just evidence, but real like exclamation points, like open your eyes, the economy is slowing. Manufacturing has slowed into contraction. We've known for a while, we've indicated that we've been highly convicted that manufacturing activity was slowing. Service and manufacturing new orders are slowing down. So that's your pipeline into the manufacturing activity. Employment growth is slowing down in the low 100,000s in terms of the amount of non-farm payrolls that were created the prior month. We're not surprised by that. If you look back to our weekly updates over the last couple of weeks, we talked about the fact that jobless claims, that week over week number, was perking up, right? You were well into the 230s and 240s. So that's important. And inflation is coming down. So all of these are things you need for inflation to come down, and inflation is indeed coming down. And we've seen that impact the interest rate environment, right? So when we look at 10-year yields, 10-year interest rates across the world, where it's US, UK, Germany, China, France, Switzerland, Australia, Canada, Italy, etc. There's a lot of red there. Red means lower. And if you're a growth investor, that's good. And if you're a value investor, that's actually good too, because it's going to perk up cyclical activity. So when we look at the 10-year interest rate, just a couple of weeks ago, we were talking 4.5% or 4.4%. Now 3.8%. That 30-year mortgage has gone from about 7.2% early last week to we exited Friday at 6.4%. These are big, big moves. And we know that interest rates can come down for a number of reasons, but the core reasons they do come down are a slowing economy, a disinflationary economy, or an emergency, right? A global emergency like 2008 or COVID or 2001, right? Those are the times when you start to see interest rates really come down. We think we're in the former, which is inflation's coming down, the economy's cooling, and the data last week was that sudden alert to confirm that. The move lower in stocks is this outsized concern of, well, what if it's more than a slowdown and it's a recession? I mean, if you look at the data, it doesn't indicate that. It indicates a slowdown. But when everyone's levered net long, the same names, especially those multi-trillion-dollar Magnificent Seven names, you get a very good excuse to take some money off the table, especially when you look at how those names have run. And we know that what the market wants, and that's a big rate cut. So in the last couple of days, we've gone from this 100% pricing in of a 25 basis point rate cut in September. We saw the Fed last week Jerome Powell speak to this idea that a rate cut is on the table. When we look at those manufacturing numbers and those employment numbers, the market's now saying, actually, I don't want 25. I want 50. I want some insurance money on the table to make sure that there is no recession. So suddenly the chance of a 50 basis point rate cut has jumped from about 14.4% to about 30%. I expect that continues to go higher. I would not be surprised if you get some sort of indication from the Fed that 50 is on the table. And that may coincide where we start to see markets start to bottom out. We already see the 2-year yield is starting to price that in. The same way the 2-year yield front ran the Fed when inflation was soaring, and the 2-year yield said, hey, Fed, like, you see this gap over here? You need to hike rates. And a lot of strategists were like, well, no, you don't need to hike rates. Well, no, they did. And the market knew it. This time around, the 2-year yield's telling the Fed, you need to cut rates. You need to cut them by more than 25 basis points. So my experience has been, don't doubt the market. The Fed is probably going to catch up to the market. So that's probably where we're heading. Again, none of this is guaranteed, of course, but we like to take cues from the market. Now, one of the reasons why we are not panicking and we're not concerned about the economy is that if the economy was a serious concern, you would have panic buying of US dollars, because US dollars is the most liquid instrument on the planet. And when there is concerns around a global recession, there's only one thing that matters, and that's global liquidity. And there's only one asset class to this day that really provides that, which of course is the US dollar. So despite the panic last week, what did we see? We saw actually a big sell-off in the DXY, otherwise known as the US dollar index. If there was a panic out there, this would be going the other way. This would be spiking higher. That's what history suggests, whether it's 08, COVID, 2001, 1987, Black Monday, those types of events, you see people pile into US dollars. US dollar going lower here suggests to us that market's pricing in a rejigging of what the world looks like from that high rate, high inflation environment to a low rate, lower growth, low inflation environment. And the market sells off when there's that uncertainty bridge that you have to cross. And then as more clarity comes in, people start to buy the assets that make sense in that new environment. And that's where we think we're at right now. In the credit markets, we're really not seeing panic selling of bonds. We're not seeing any panic selling in terms of investment grade CDS spreads, high yield CDS spreads. You're not seeing those risk spreads blow out. Again, we combine the action in the US dollar, which is moving lower, not higher, and you're looking at corporate credit spreads that are really not blowing out in any serious way whatsoever, at least not yet, right? We'll keep our eye on it. Again, that balance of evidence suggests, again, that soft landing versus hard landing. And we want to be in this environment where we're constructing portfolios for a new low interest rate, low inflation type of environment. So as rates move lower, what we want to ask ourselves is, okay, this recipe for rotation, we think the real move was those small cap moves 2 weeks ago. They've really sold off after that breakout back into the breakout point. Inflation down, interest rates down, US dollar down. We want to be in those types of assets that are going to do well in a lower rate environment. So what's the playbook? Last week, we had 2 playbooks. We had the Trump playbook and we had the Fed cutting playbook. Let's focus on the Fed cutting playbook because the election's 50-50, right? So when the Fed starts to cut, the sectors that historically benefit when we're not going into a serious recession, Bitcoin, small cap, regional banks, commercial real estate, M&A, and of course, cyclicals. What doesn't do so well? Energy and healthcare. As you know, we've been serious sellers of energy over the last 3 or 4 months. I think that's been a good call. And I think that sector continues to weigh heavy over the next couple of months as we ratchet down from that 4% GDP level to the 1 to 2% GDP range. Long term, we love energy, and we're going to use that as an opportunity to rebuild energy positions. But as of right now, we would be on the sidelines as it relates to energy. But these are the sectors that historically benefit from a low interest rate and deregulatory type of environment. We know the playbook if this does play out, which is the mid 90s when we had the inflation surge, early 90s. Fed comes in, hikes rates, kills off that inflationary surge, and then does what we call a mid-cycle interest rate cut. And what happened? S&P rallied for 4 years. We think this is the playbook to follow. So key takeaways here. when we go into the first, was we're going into really the first, second week as kind of a blend here in terms of August, is that when you have a week that goes, everything goes down, instead of panic, let's focus on what we think will work with those types of market symptoms when the selling does end. Three big things. That center of the storm remains technology stocks, right? Especially those magnificent seven names. I don't think it's time to step in there yet. We've had a lot of crowded investment into that space. Unfortunately, when those biggest names do sell off, it causes a cascade effect across the wider market. We wouldn't get too rattled with the names you own. Focus on the stuff that's going to work after the intensity of the selling is done. Slowing economic growth, we think, is leading to much lower interest rates. Now we're throwing a 3 handle, not the 3 handle, we're already there, but a 3% handle on there. Small caps, digital assets, emerging markets, and cyclicals. We do look at what historically benefits, and those are the areas that historically benefit from lower rates. So this is what we got for you this week. 888-543-3776. Feel free to reach out if you have any questions, concerns. I know no one likes to see their portfolios go down in value. I think we've learned a lot of great lessons from 2022. And I think the biggest one is patience. Don't try to chase things around as markets are whipsawing. Have conviction in what your models are saying. Have conviction in what your process is telling you what to do. And we look at our process right now, we really look at an environment where rates are going to be lower, non-recessionary, which is means sort of focus on some of these smaller cap growth names, and as well as some deep value names as well, and especially emerging markets. So we got for you this week. Have a fantastic week. Have fun out there. It's the last month of summer, so enjoy it while you can. And that's what we got for you. Thank you again, and have a fantastic week.